At the heart of any trading strategy is how your winning trades stack up against your losing trades. And in order to be profitable, the amount you accumulate in wins must be more than the amount you accumulate in losses. So in this lesson, I'm going to show you how to be profitable using risk to reward ratios. A risk-reward ratio is the metric used to evaluate the potential return on a trade relative to the amount of risk taken to achieve that return. For example, if a trader were to risk $100 to potentially make $200, then the risk reward would be 1 to 2. This is what we call a positive risk reward. You are risking less than the amount that you stand to gain. If a trader were to risk $100 to make $50, then the risk reward would be 2 to 1. This is what we call a negative risk reward. You are risking more than what you stand to gain. Now, the reason risk rewards are important is because it provides a more comprehensive understanding of what your strategy needs in terms of win rate in order to be profitable. Now, this chart shows the relationship between risk reward and the win rate needed to break even. Anything in this green area are positive risk rewards. And if you notice, the win rates needed to break even are lower. The reason is because every time you lose, it will be a smaller amount of money than every time you win. For example, if you were to use a 1 to 3 on every trade, risking $100 to make $300, every time you lose, it would be a $100 loss, but every time you won, it would be a $300 gain. So because all your winners are triple the size of all your losers, you would need a win rate that is above 25% to be profitable. Now, while it might seem it would be easier to be profitable using a positive risk reward because of the lower win rate needed, it could still be a little bit challenging. Trades with a larger profit target often have lower probabilities of success as they require the stock to move significantly in the desired direction to achieve the target. So your win rate will tend to naturally decrease pursuing higher positive risk reward ratios. It would be extremely difficult to get a super high risk reward with a super high win rate every single time. The reason is because market conditions are different from day to day. Some days the market will be volatile enough to make those significant moves, and some days the markets may be a little bit stagnant where we only see small moves. So it's kind of expected that you'll have a lower win rate when always using positive risk rewards. But the key to being profitable using this type of risk reward profile is to have a win rate that is higher than the break-even win rate. So if you were to always use a 1 to 3 risk reward, don't expect a 90% win rate. But to be profitable, just don't go below 25%. So aiming for a win rate between 40 to 60% would be realistically achievable and very profitable using this type of risk reward profile. Now let's talk about the negative risk rewards. Anything in this red area is considered a negative risk reward, and it's where you are risking more money than you stand to gain with each trade. And as you may have noticed, the win rates needed just to break even are much higher. And the reason is because every time you lose, you are losing more money than every time you win. So if you were using a risk reward of 2 to 1, that means you are risking $100 to make $50. So because all your losers are double than all of your winners, you need a 67% win rate just to break even. Now, using this type of risk reward profile can be a little bit challenging because there's a bit more pressure for you to maintain a high win rate just to break even. So there isn't really a whole lot of room for error. But taking trades with much smaller profit targets have a higher probability of success since they don't really require a significant move to hit the target. So your win rate will tend to naturally increase pursuing negative risk reward ratios. But the key to being profitable using this type of risk reward profile is to maintain a win rate that is higher than the break-even win rate. So if you are using a 2 to 1 risk reward on every trade, a win rate between 75 and 90% would be realistically achievable and profitable. So You can be profitable using both negative and positive risk rewards. Okay, both strategies can produce similar results if done correctly. It's just you have to understand the probabilities of price hitting your targets with the strategy that you were using. This is just like how a casino structures their payouts based on the probabilities of the game they were offering. Casinos have games that use both positive and negative risk rewards, and each game is profitable for them because they know the math behind the game and the win rate that it produces. A common mistake I see a lot of traders make is using risk reward ratios without really understanding the probabilities of their strategies. In order to use risk rewards correctly, you have to use a strategy that will hit the targets at a higher rate than the break-even rate. I hope you all learned something, and I'd like to thank you so much for watching.